Hello everyone and welcome to this quick fire revision for Ind AS 38 intangible assets. It's a tier 2 category standard and draws a lot of its inspiration from Ind AS 16 property, plant and equipment. A few special cases which are unique to intangibles as well that we will discuss over here. So when we look at intangible assets, there are three distinct features for something to be shown as an intangible. First, it has to lack physical substance, that is, it should not be something that you can touch, feel, see. Second, it has to be non-monetary in nature. That means an item where you do not have a contractual right to receive a fixed or a determinable amount of cash. Like for example, when you look at a bank balance is monetary in nature. You cannot probably physically touch or feel the bank balance like you can do for cash. However, it lacks physical substance. However, it is monetary in nature. But items like patents, copyrights, trademarks, etc., they are non-monetary because the value that they have is not contractually fixed or determinable. You do not have a contractual right to receive a fixed or determinable amount, and hence an intangible asset has to be lacking physical substance, it has to be non-monetary in nature, and very importantly, it has to be identifiable. Among all the three, I would say identifiability is one of the most important criteria. Identifiable means it has to be capable of being separated out and sold separately, or it should be a contractual license or a right that is derived, irrespective of whether it can be separately sold or not. So for example, when we look at separability, so something like a patent. So if I have a patent to manufacture kerosene, I can just sell that patent separately without selling the entire business. However, if Maruti has a 40% market share in the automotive segment, then Maruti cannot separate out and sell just the market share. It can transfer that along with the entire business if someone comes and acquires Maruti. However, just the market share cannot be transferred. So market share is not separable. However, items like patents or copyrights are separable. Secondly, there can be items which give you a contractual license or a right, like a telecom license or a franchisee right, for example. This arises out of a contract. Now, in all likelihood, there might be restrictions in the contract on transferability, like a telecom license may not be allowed to be transferred or a franchisee right may not be transferred. However, since this is a license or a contractual right which arises, this can be shown as a separate intangible asset irrespective of whether it is separable or not. It is still considered to be identifiable. So in identifiability, one of the two has to be fulfilled. It has to be either capable of being separated out and sold separately, or it has to be a contractual license or a right that arises out of a contract. Like a market share, even over here, Maruti does not get its 40% market share from a license or a contract. It is probably out of customers, let us say, interest or customers' preferences that it enjoys this market share. Now, once these three criteria are fulfilled, we can say a particular item is intangible. Now, if it is intangible, can it be shown separately in the balance sheet? Well, it can be shown if it is an asset that is a resource controlled by the entity due to which an entity expects to receive future economic benefits. It is an asset which fulfills these criteria and is within the control of the entity. So, we'll do the special cases. However, it has to fulfill the intangible criteria. Second, it has to be something which is controlled by the entity. It may not be owned, but it has to be controlled by the entity as a result of past events for which you expect to receive future economic benefits. So, like research expenses, as you will study further, are taken to the profit and loss. They are expensed to the profit and loss account because the research expenses may not necessarily give future economic benefits, and hence research expenses cannot be capitalized as an intangible asset. Similarly, in most cases, when we look at human resources like employees, cannot be owned or controlled by the entity, and as a result, they cannot be shown as intangible or tangible assets as a case may be. In most cases, there are certain exceptions. And last and the most important criteria is the cost has to be measurable. And this is the reason why a lot of self-generated assets or internally generated assets are unable to be recognized in the balance sheet. Like internally generated brands, for example, may not be recognized in the balance sheet because the cost that has gone behind development of these brands may not be determined reliably. Okay, so over here, when we look at intangible assets, well, there are three components. When we see for intangible assets, it has to be identifiable, it has to lack physical form, and it has to be non-monetary in nature. Further, once it is meeting this criteria, we have to see whether it is controlled by the entity and is capable of giving future economic benefits, and the cost that has gone behind this is measurable reliably, in which case you can recognize the intangible asset in the balance sheet. Now, before we proceed further, we need to understand a few special cases. First, deferred revenue expenses like major advertisement expenses or major training expenses or incorporation expenses. Can they be recorded and deferred over 3 or 4 or 5 years? The answer is no, because they do not meet the identifiability criteria. These items are at the end of the day expenses. If you want to capitalize and then amortize it, it has to be capitalized as per a particular standard. They're not inventory, not PP. They're not even intangibles because they lack the identifiability criteria. You cannot separate out and sell the training or advertisement expenses. Again, it does not give you a license or a right on any matter, and hence there's nothing called as deferred revenue expenses, at least in general under Ind AS 38. In case there are certain expenses like these major advertisement training expenses, they will be going to the profit and loss account. The reason if asked is because they lack the identifiability criteria. Second, goodwill. Goodwill is recorded as per Ind AS 103. Remember, it is not recorded as per Ind AS 38. It is recorded as per Ind AS 103 business combination. Goodwill is the difference, loosely speaking, between the purchase consideration and the net assets. That will give you goodwill. Now, this is considered to be the sum total of all unidentifiable asset, like for example, the customer list or clientele that you have, the skilled manpower that you have, all of these. Past reputation, track record, all of these are subsumed within the goodwill value, and goodwill self-generated cannot be recognized because the cost is not measurable reliably. In any case, it is unidentifiable. You cannot just separate out and sell the goodwill separately, and you cannot even get a license. And hence, goodwill, if it has to be recorded, it has to be recorded as per Ind AS 103, which is recorded at the stage of purchase or acquisition of control over a business. Goodwill otherwise is not recorded for as per Ind AS 38. Next is about human resources. See, human resources in general, like employees, cannot be controlled by the entity. They cannot be owned or controlled by the entity, and hence you cannot record human resources as separate assets. However, in certain circumstances, if the terms of the contract are such that they kind of, in a way, implicitly prohibit an employee or prohibit, let us say, a human resource for working for someone else, or they kind of implicitly require the human resource to render service for a specified period, then based on the facts, control can be established. Then you can show them as intangible assets, because you can't physically own the player, or you can't physically own the human resource, but you can have the right to receive the services, like player rights. So let us say you look at players in the IPL or players, let us say, in the football leagues, you will find that there are very strong restrictive clauses. You might have heard that certain players are getting 15 crores, 20 crores, etc. There are very strong restrictive clauses that the player cannot leave at his will by giving a 1 month notice and go to another club. No, the player has to render service, let us say, for a period of 5 years. And as a result, the club gets the rights to utilize the services of the player. The club can use the name of the player and sell t-shirts, etc. as well, merchandise as well. And hence, we have the rights to utilize the service of the player, and the player cannot leave at his choice. And if he wants to leave, there are humongous amounts of penalties which kind of prohibit or kind of in a way restrict the player from leaving. And as a result, over here, in case control can be established, then these intangibles, player rights, can be shown separately as intangibles. A lot of international football clubs which actually publish their financials, you will see player rights being shown as intangible assets as per IFRS as well. A special case over here that you need to focus on is on research and development. When we are looking at research and development, research cost is the cost incurred during the ideation phase. Like if I want to find a medicine that can cure HIV/AIDS, it is an idea that I have. Any expenses that I am incurring towards finding that vaccine or towards finding that medicine is considered to be expenses during the research phase. They have to be expensed to the P&L because future economic benefits are not certain. However, what about expenses during the development phase? Development phase is the phase that starts after research successfully gives a probable outcome or a product. So once the idea, let us say you find a molecule that can kind of kill the HIV/AIDS virus, then your research phase has ended, but I can't start administering that drug to the public at large, in which case the development phase starts. Now within the development phase, what we will have to do is, we will have to see whether the expenses that are incurring during the development phase, like clinical trials, approvals, etc., if they are towards an asset which is technically possible, which is legally permissible, which has a market that is financially visible and cost measurable. If these conditions are satisfied, then the expenses incurred during the development phase can also be capitalized. Otherwise, expenses incurred during the development phase will also be taken to the P&L. Now, in cases where we are not certain whether we are in the research phase or development phase, Ind AS 38 guides you and tells you that you will consider that you will be in the research phase and expense out to the profit and loss account. During the period of development, Ind AS 36, read with Ind AS 38, requires you to test the asset for impairment annually, at least. You don't have to amortize till the time the asset is ready for use. However, till the time the asset is ready for use and it is under development, an intangible under development is to be tested for impairment at least annually. That is, you will compare the carrying value with the recoverable value, that is the higher of the fair value less cost to sell or the value in use at each balance sheet date. And if there is an impairment, you will book a write-off. Next, there is a impact of this along with Ind AS 103 business combination. Usually research expenses are taken to the P&L account. However, if you are acquiring another company and as a part of that acquisition you are acquiring the in-process R&D of that company, then Ind AS 103 allows you to record that at the fair value at the stage of initial recognition. It is possible that the selling company might not have recorded any asset for this because it is under the research phase. However, while acquiring a company, I am willing to pay a particular sum of money for that research because I need to know ways or experiments that you have conducted which don't work, and hence there is a fair value of the research that you have done, in which case under Ind AS 103 you can record that at the fair value at the stage of initial recognition as well. That is permissible. So these are the few special cases that you need to kind of go through. Next is amortization, which is unique to intangibles. What is depreciation for a tangible asset is basically amortization for an intangible asset. If intangible assets have a finite life, and finite life can be the useful life or the legal life as the case may be, then you are required to amortize the intangibles over the finite life on a systematic basis, and if no systematic basis is available, then on a straight line basis. What can be systematic basis? Well, anything can be taken as systematic basis depending on the facts of the case. However, the standard says that the revenue based amortization is inherently not appropriate. Like, you cannot say that we will amortize in the ratio of revenue that we will generate over the project, because you are in a way linking a fixed cost with that of revenue, and as a result the standard says inherently a revenue based amortization is inappropriate. There is an exception to this as well, however that is not very important. Like, if the intangible actually amortizes based on the revenue, like for example you are an author and you have you are a publisher, and an author has given you a license to publish their and sell their books up to 1 lakh books, up to 1 lakh copies, in which case the license that I have, let us say to publish and sell Harry Potter series, I have that license only up to 1 lakh books, in which case the license amortizes as and when I sell the books, in which case in the rarest of the rare case a revenue based amortization can be permitted, but in other cases a revenue based amortization is inherently not appropriate. What about intangibles with an indefinite life? Now this is where AS and Ind AS differ. AS used to say that you will amortize this over 10 years. Ind AS says, why should you amortize it over 10 years? It has an indefinite life and hence there will be no amortization. However, this will be aggressive accounting, because once you determine a particular intangible asset, you will not really amortize it. Now, this is not what is always necessarily going to be the case, because sooner or the later the value of the intangible might fall, and hence Ind AS 38, again read with Ind AS 36, requires you to test this intangible asset with an indefinite life at least annually for impairment. So basically there are 3 items which Ind AS 36 requires you to test for impairment at least annually, that is intangibles under development, intangibles with an indefinite life, and goodwill under business combination. The common thread which connects the 3 is all the 3 are intangibles and all the 3 have no amortization, and hence you need to test them for impairment at least annually. Okay. Next, you have other accounting principles which are there for intangibles. Remember, the other accounting principles by and large are similar to that of a tangible asset. That is, initial recognition of intangible asset should happen at cost, which includes purchase price, non-refundable, non-creditable taxes, directly attributable expenses, borrowing cost if it is a qualifying asset, etc. Special cases like deferred payment and barter apply. Like in case of payments which are deferred at or beyond 12 months, you will recognize them at the present value or the cash price equivalent. And if it's a barter, you will recognize them at the fair value of the assets given up, first preference. If not, then fair value of the assets received. If not, then the WDV of the assets given up if the barter has commercial substance, and if it lacks commercial substance, then you will recognize them at the WDV of the assets given up. If there are subsequent expenditures which increase life or efficiency of the intangible asset, you will capitalize. In other cases, you will expense. If there's a major replacement or a major expenditure, you can capitalize that and subtract the WDV of the old expenditure. Then the change over here that arises is in subsequent valuation. In the balance sheet as per PP, you can measure using cost model or revaluation model, and that is a free choice that you have. However, in intangibles, you can use the revaluation model if and only if the fair value can be determined of the intangible asset from an active market. Like in certain cases, I mean, these are debatable terms, but items like carbon credits, or items like Bitcoin, cryptocurrency, etc., can arguably have a fair value from an active market, and if they are classified as intangibles, then you can also follow revaluation model if you want to. However, items like copyright, patents, etc., might not necessarily have an active market, and hence the application of revaluation model over here is not possible, because the fair value has to be determined from an active market in case a revaluation model is to be followed. Otherwise, you'll have to follow the cost model. Other principles of amortization continue to remain the same as that of depreciation for a property, plant and equipment. So we have also given a small video separately about crypto accounting. You can refer that separately if you want to. Having said that, it is not there in the institute study material, and based on the legislative provisions as they stand currently, cryptos can be taken to be intangibles. They're not cash, they're not cash equivalent, they're not legal tender. Arguably, they can be financial assets if there's a definition amendment that comes for financial asset to include virtual or digital currency. They're not land buildings, so they can't be investment property, and hence they fall under the intangibles as per the general guidance given internationally. Having said that, IASB or ICAI has not clarified anything on that regard. So this by and large takes care of the chapter on intangibles. I hope this video has been helpful. I'll see you soon with another video. Till then, have a good time, study hard, goodbye and take care.